Hey everyone, happy Saturday. And I can still say that because it is technically still Saturday at the recording of this video. And for Stock Market Saturdays this week, we're going to be talking about dividends explained and more importantly, how dividends are taxed, because that was my initial question. That was my hypothesis that I needed to get down to the answer. So today's agenda will include an intro of some housekeeping things, some details, and then I'm going to briefly go over like what a dividend is, what you can expect if you are a dividend shareholder. And then I will go into the different types of dividends that there are, because there's not just one type. I'm going to explain those details, as well as at the end, I'm going to explain how a dividend tax is calculated based on the type. And then I'm going to give an example with some actual numbers. Alrighty, so first thing, this is not financial advice. This video should not be construed as that. This is just me sharing my personal research of what I am trying to learn concerning bettering my own dividend portfolio. It is a baby portfolio at this point. It's under $5,000. It's really under $3,000. So I am trying to learn things. And every once in a while, when I'm doing one thing, a question comes up that I don't know the answer to. And I'm saying, I should look into it. And this is what I'm doing. But none of this stuff that I'm talking about is from a professional, because I'm not a professional. And if you are interested in learning more about it, you need to seek a professional about it before you do anything. All right. Before I go into what a dividend is, I really wanted to talk about how great of a week we had in the stock market. We are comfortably over 45,000, and that hasn't happened, y'all, since December of last year in 2024. And we have had a time these last 8 months trying to save our portfolios, especially in March and April. It got really bad, and we lost about 3,000 points. And so from April to now, we have finally seen those losses at least recovered and even better off for it. But that's the name of the game when you are investing in the stock market. That is like quite normal, but it's just happened to see. Another thing is, in the last quarter, it is historically known, as I have learned, to be a slower time for the market, and you'll see, or it's more probable to see decreases in the market. With that being said, we still have some time before the end of the year, God willing. So even if there are decreases, I think it's a fair thing to think that we'll probably still be around 45,000 safely, and even more hopeful, maybe we'll be at 46,000 safely. And safely, I mean, it's like it just staggers around that point. So yeah, that was a nice little thing that happened this week. Now let's get into like what I came to actually research, and that is, what is a dividend and how am I taxed on the dividend? So a dividend is a payment of a company's earnings to a shareholder. When you buy a part of the company, you give them money so they can do what they do to make the company better. They promise you a dividend as long as you hold it. And these dividends are paid out monthly, quarterly, semi-annually, or yearly. And if they're feeling really good because they're having a really good year, hello NVIDIA, hello any other company, I can't think of it right now, but NVIDIA is the main company I think about. They might, if they're feeling nice, give a special dividend. They are able to do that. And then this dividend can be paid out in cash or additional stock. Either way, option one or option two, that is money in your pockets. Cash is immediate money, and that additional stock is future money. Because let's say they say you have to wait at least a day to cash it in. If you cash it in the next day, you're going to get some more cash. Now, some details on some terminology that I came across when doing my research are listed in this slide. The first one is called the declaration date, and that is when the company's board announces the dividend amount and the dates. And they will typically post that on like their website, official, where that business is held. They will post that for shareholders to know how much they're going to be paid out and when they're going to be paid out in the next year. The next important term that I wanted to talk about is called the ex-dividend date. And that is when investors have to own the stock before this date in order to get a dividend paid out in that interim. So today is the 30th. Let's say ABC stock has a ex-dividend date of September 1st. I have to own that by tomorrow, August 31st, because on September 1st, it's actually too late. I have to own it before September 1st. Now, if I own it by August 31st, I will get something in the form of a dividend paid out. If I buy it on September 1st, I won't get it the next payout date. I will get it at a future one. The record date is the date that the company records all of its shareholders who will receive a dividend payment. And so the record date, let's say if the ex dividend date is September 1st, the record date is probably going to be August 31st, because that's when they're going to go in and just get a tally of who owns it. So they know come November 1st, if there's someone not on that list, that means they paid for it on November 1st. And then the payment date is the date that the payment is distributed to us, the shareholders. Now, as far as the types of dividends there are two. There are ordinary dividends and there are qualified dividends. Ordinary dividends, which is news to me, they're the most common. They are taxed regularly, and that tax rate is the marginal tax rate that goes from 10 to 37%. I did not know ordinary was more common, but they are, and they're taxed like our regular income tax. Our income is taxed on a marginal tax rate. But then we have qualified dividends, which are taxed lower. And this is what attracted me to dividends in the first place. My problem is most of my dividends at the moment are ordinary. They're not qualified. But nonetheless, qualified dividends are taxed at 0, 15, or 20%. And we will go into what you need to get those percentage rates quite soon. Now, I'm not going to talk about the ordinary ones right now because those are the most common and they're taxed pretty much what we're more familiar with, because Americans have to pay their taxes every year. Most Americans don't have dividends though. So I want to talk about the qualified dividends, which are a little bit different from our regular taxes. And what I did learn was that the requirements for a qualified dividend is that they have to be paid by a U.S. corporation or a qualified foreign corporation. And the qualified dividend has to be held it has to be held for a specific time period. And how I understand it is that it has to be held for more than 2 months in a consecutive 4-month period. I put the parentheses in here with the number dates, but it has to be held more than 2 months. So not 2 months, not 60 days, more than 60 days in a consecutive 4-month period to qualify. And then we have the rates on how they're to be taxed based on someone's income. And I put 2024 rates. So if you are single filing status, you pay 0% on those qualified dividends that you receive if you make less than $47,025. If you make $1 more than that, up to $518,900, you pay 50%, and more than the $518,900, you pay 20%. But not everybody is single. Some people are married filing jointly. And there, to get the 0%, you can make double, pretty much, because double of $47 some odd dollars is $94,950. To pay 15%, you make $1 more than that to $583,750. And then 20% is anything $1 more over $583,750. And then if you have the status of head of household, 0% is up to $63,000. 50% is $63,001 to $551,350, and 20% is $1 more than that. Another thing to take into account is if you're a high earner. High earners have to pay something called a net investment income tax, and the cutoff is if you make more than $200,000 as single or head of household, you're going to have to pay that income tax on anything more than $200,000, and you'll pay more. And you'll pay more if you make $1 over $250,000 if you are married filing jointly. And that tax is 3.8% on the net investment income. So let's say someone is single and they make $220,000. They only pay that 3.8% on the part that's over $200,000. So that's $20,000. If they only make that's not a lot. If they make $202,000, they only pay the 3.8 on the $2,000, not the whole $202,000. So that was definitely something I didn't know. And I'm not going to put a limit on my Lord's blessing. There is one day I could be making $250,000. So yeah, why not? As far as the tax is concerned, I did learn a lot from this research, and I'm happy to share that it's 3 steps. So the first one is you find the total taxable income, and what that is a number that you can find on your 1040 form that is filed every year for most Americans. And that number is found when you take the adjusted gross income, also known as the AGI, and you subtract either the standard or the itemized deduction. I'm using the standard deduction because that's what I've been using lately. I have done itemized before, but I'm using standard for my calculations. That's coming up in a little bit. Step 2 is you're going to separate dividends from your 1099-DIV form. On that form, or multiple forms if you have different areas, if you have from a business that you own one stock in, from Robinhood, Emblem Finance, Vanguard, whatever, you're going to get a bunch of 1099 DIV forms. Box 1A is telling of your total ordinary dividends. So if you have one, just use one, but if you have a bunch, add all those up. And then box 1B is telling of your total qualified dividends. And I looked it up in my own forms. It's true. It's like amazing when you know what your tax forms are telling you, as opposed to when you didn't and you just trusted your accountant. Step 3, so you have those numbers. So then step 3 is then you're going to calculate the tax on each type. Now for ordinary, you're just going to add to the regular income and calculate the tax based on income brackets, which most people are familiar with, at least on the surface. But for qualified, I don't know if you can see it on this slide, but you only tax is going to be 0, 15, or 20% based on the total taxable income. So we're going to do an example right now because I know that was just like a lot of words. And the example is going to be me. So the details about me. I put wages as $50,000, and that's more or less the truth. These are not my exact numbers, but more or less it's similar, right? Because $50,000 is pretty much what I make. Maybe 53, maybe 51, maybe 49, maybe 47. But around that, you would round to 50. Either way. I put qualified dividends as 500, and I put ordinary dividends as 3,000. So my adjusted gross income is 53,500 because I add all those together. Now, my standard deduction I'm using from the 2024 amount of standard deduction, which was negative 14,600. So that brings my taxable income to 38,900. Now, qualified dividend tax, I'm paying 0 because my qualified dividends is $500. So I'm trying to see how much of my $500 of my qualified is going to dividend. But if you look under qualified, according to this filing status, 47,000 is the cap, and I make less than that at 38,000 and some change. So that's why my qualified thing is 0, which makes me a little sad because $500 to me would be good, right? Especially since it's my first year. That's a lot. No, that makes me happy because I'm not being taxed on it. So yay, great. Now, ordinary dividend tax, this made me sad because I get more at the moment. I get 3,000, and that's kind of similar. That's a true, almost true number to what I actually get from my last employer, right? I got to pay a lot more taxes on that, and that could be 10 to 37% depending on the brackets. So when I figure out what it is, I have to do 10% of the first 11,600, and that comes out to $1,160. And then I don't know if you guys can see it. I'm sorry if you can't. Then I have to do 12% of the next part, which is 27,300, and that's going to lead me to $3,276. And then when I total those, it comes out to $4,400 pretty much. So what I learned from my own numbers is that the bulk of my dividend income is added into my overall income and how it's taxed. And that's great. But I pay more taxes on it. My $500 dividend thing, I'm not saving that much money because it's not a lot. Now, when I will be saving money is that hopefully that $500 is literally, y'all, $40,000 a year in 30 years. That's what my goal is. I want $40,000 a year coming from this dividend thing, right? When that happens, because we're going to speak into existence, that means I will not be paying as much money. I'll only be paying up to 20%, as opposed to if it was the other way around, I'd be paying up to 37% if it was ordinary. So that really helped me understand that for where I'm at in my journey, the benefit doesn't happen until I make more money. And I would have to slow down my ordinary dividends to not pay as much taxes, but I want that money. So I just have to eat the fact that I'm going to pay more taxes on it. But yeah, that is the explanation of how the dividends are taxed in a nutshell. I tried to use rounded numbers and small numbers and non-complicated numbers to share what I found. I hope it was helpful. Let me know in the comments any thoughts, questions, or concerns, as well as let me know in the comments if there's something else you guys want me to talk about on Stock Market Saturdays. Give me some suggestions. And if it's something that I feel I can put into a show, I will definitely come back to y'all with it. And next episode will be on some type of foreign market, whether it's Africa, Asia, South America, something like that. I did one on Europe, and I owe y'all one for somewhere else around the world. I was talking about Asia's market last money show, so that might be it. But regardless, it's going to be about something else in the market. Anyway, toodaloo, guys. I will see you guys next Stock Market Saturday. Thanks for joining. Have a good one.